Friday was supposed to be a normal day. Markets were riding a 9-week winning streak. Investors were feeling good. Then one number changed everything. The May jobs report came in at 172,000 new jobs. That is nearly double what Wall Street expected. And within hours, the S&P 500 dropped over 2.6%. The Nasdaq fell more than 4%. It was the worst single day on Wall Street this year. But here is what the headlines missed. The real damage was not in the stock prices. It was in what that jobs number did to interest rate expectations. Because this week, the entire story about where rates are going just flipped. Let's go back 6 months. At the start of 2026, nearly every major bank and analyst was predicting the same thing. Rate cuts were coming. The Federal Reserve would ease borrowing costs. Inflation was cooling. The economy was slowing enough to give the Fed room to move. That was the consensus, and markets rallied hard because of it. But something started to shift around March. The Strait of Hormuz closed following the Iran conflict. Oil prices jumped sharply. Energy costs fed into broader inflation, and the confident prediction of multiple rate cuts began to unravel. Then Friday happened. 172,000 new jobs in a single month. An economy that is not slowing. It is accelerating. And suddenly the conversation is no longer about when the Fed cuts. It is about whether they might actually hike. According to the CME FedWatch tool, the probability of at least one rate hike this year hit 72% by Monday morning. That is a massive shift in a very short time. Now here's the part that matters for you. Because most financial coverage focuses on what this means for stock prices, but rate expectations affect far more than your brokerage account. They affect your mortgage. They affect your car loan. They affect your credit card balance. They affect the cost of every dollar of debt you currently carry. When markets were pricing in cuts, fixed mortgage rates had started to ease slightly. That window may now be closing. A potential hike means banks reprice their lending products upward. If you were waiting for rates to drop before refinancing, that calculation just changed. If you have variable rate debt, the pressure on your monthly payments could increase. This is not a warning designed to frighten you. It is context the market news rarely provides clearly. Now let's look at what this means on the other side of the equation. Because rate hikes are not purely bad news. There is a group of people who actually benefit. If you are holding cash in a high-yield savings account or money market fund, higher rates mean more income on that cash. The 2-year Treasury yield is already offering meaningful returns above cash. Charles Schwab's fixed income team noted this week that the 2-year Treasury is now offering a 50 basis point pickup over cash. That is a real, tangible number. For everyday savers who have been sitting in low-yield accounts, this environment creates actual opportunity. Hold that thought, because the way you position your savings right now matters more than most people realize. If financial literacy matters to you, subscribe and join the community. We break down the news every week in plain language. There is another layer to this story worth understanding. WTI crude oil closed Monday at $91.77 per barrel. That is not a normal oil price. That is energy inflation still working through the system. And energy costs do not stay isolated in gas prices. They move into grocery prices, logistics, manufacturing, and services. The Bureau of Labor Statistics already reported that U.S. grocery prices rose 0.7% in April alone. That is the largest monthly grocery increase in nearly 4 years. Higher fuel and transport costs are directly driving up the price of meat and household staples. So the Fed is watching a labor market that is too strong and an inflation picture complicated by energy supply shocks. That is not an environment where cutting rates feels safe, and the market priced that reality in brutally on Friday. So what do you actually do with this information? First, take a serious look at your variable rate debt. If you are carrying a balance on a variable rate credit card or a home equity line of credit, a rate hike environment means your interest charges will increase. Prioritizing paying down that debt now is not a defensive move. It is a financially aggressive one. Second, revisit where your short-term cash is sitting. The era of accepting near-zero returns on savings accounts is not something you have to accept anymore. Treasury bills and high-yield savings products are offering real returns right now. Getting that cash working is a practical step anyone can take this week. Third, do not make dramatic changes to your long-term investments based on a single Friday. The S&P 500 is seeing some recovery today as chip stocks rebound. One data point does not define a year, but it does shift the context. And understanding that context helps you make smarter decisions across the board. Here is one more thing worth sitting with. The Federal Reserve's new chair inherited an uncomfortable situation. Energy shock inflation is different from demand-driven inflation. You cannot fully solve a supply shock by hiking rates, but you cannot ignore an overheating labor market either. The Fed is navigating a scenario where both tools available, cut or hike, come with real trade-offs. That uncertainty is exactly why markets dropped as hard as they did. Investors are not afraid of one jobs report. They are afraid of an extended period where nobody knows what the Fed will do next. And that kind of uncertainty costs money whether you are invested in stocks, planning to buy a home, or running a small business trying to manage costs. The numbers this week told a very clear story: a strong labor market, rising energy prices, inflation that refuses to fully cool, and a central bank being pushed toward a decision it did not want to make this year. What you do with that information is entirely up to you. But the people who adjust their financial plans based on changing realities, not just headlines, are the ones who come out ahead.